Greetings, market rebels. Welcome to this week's macro measure video combined with sector situation video. It is Friday, November 14th, 2025, and it's a little bit after 4 p.m. I think it's about 4:20 something here on the East Coast. Let's see, get the trusty disclaimer flashed here from Market Rebellion. Let's get the trusty intellectual property rights notice flashed here. And I'm Wayne, and we're going to get into it. And here is last week's main slide. We covered other slides from prior weeks, but this was the main one. Didn't even have time, recording this late, so did not even have time to really go through this. But did want to note that just we saw that maybe there was a rally coming with what was happening, maybe with the dollar backing off, and then BTC hinting at a rally attempt. We got a squeeze to start this week, so I think we brought the right read in, and I think we had the in terms of just a guess, right, of how the week would start, and then we said we'd see really what would happen from there because of some of the things. I think I put some warnings in there, so I'm trying to recall where I placed them or if I just noted them. But I think what it came down to is we would see how far they could get and if they could hold. And that was really the missing piece this week. And let me get to this week's slide for that reason. And so I'm going to skip down right here to people don't care for these caveats that we put in there. But those are from learning the hard way a very long time ago. That's why the caveats are there, and the fact that those caveats have been reinforced time and time again by the market, by its behavior. And so all that really means is if I think that something's going to try to pop and then get above a level, much like with a trigger, it really doesn't matter for trading if you're trading for any length of time beyond just moments, right? If something can't hold the trigger, or if it can't hold a technical level, you get one close above there for swing and longer term trading. That's really not a big deal, right? They can pretty much do anything in one day. Look at today, for example, where it was a perfect setup for them to do exactly what they did, which we'll talk about. But effectively what I'm skipping to is they got things down to a critical support level. I didn't even have to redraw the lines. It just literally got right near there and then held from there. And that's what we assume, that without something really serious or material unfolding at the time, you're likely to get supporting the first time you reach it. So it usually takes a little bit more to just plunge right through major support in my experience. Anyway, let's go through this methodically. So I still think you got to go to 2x when I'm talking. Super interesting times. One question this week is is there enough fear and damage to bring Santa to the launch pad? Santa really doesn't get into the sleigh for a while, but you get the idea, I think, that could this be enough to really shake out the knaves and ne'er-do-wells and get this thing going? That's a big question. Don't know the answer to it, just raising it. The rally reason soapbox comment, that has to do with me just getting on the soapbox briefly saying, it's very hard for me to listen to the financial media or what it's become, because they are always in a rush to assign a reason to a rally. And I'm telling you right now, I don't really care what they said. I don't even know what they said. And I'm a nobody, fine. But I'm just saying that be wary of those things, because there's not always a reason for what happens. It was basically, right, you get a week that was rough. You get people that have been conditioned to buy on Fridays. You got people that have been conditioned to cover on Fridays. You've got all that kind of stuff coming in and what's been typically happening. And so you open down ugly after a couple of ugly sessions. And of course, there's going to be some support that comes in, and they're going to try to squeeze things back up, which they did. And so I would once again argue that the market's internal plumbing was a lot more responsible for what happened today than whatever they assigned to it in terms of the turnarounds. Anyway, we had sell on reopen news, basically. with the government. That's what you've always got to look out for when people start ballyhooing something that's very well known and this wonderful thing. And we did also learn that retail recently, we learned that retail was loaded to the gills. So retail was really, really long. And we also have noted that when we've been in the consensus, which we found ourselves in because we've been flipping back and forth, ready to go with bulls or bears, while this whole sort of challenging consolidation and corrective phase has been playing out. And we don't know if there's another leg to it down yet, or we don't know if it's over. So, of course, as traders, we've been trying to flip back and forth and we've just tried to be objective and call it as we saw it in terms of, hey, this looks a little bit better on balance, or this looks concerning on balance. But we have been noting that we've seen distribution. The consensus is just a dangerous place to be. Every time I find myself really agreeing with the consensus, which is usually bullish without a lot of care or concern for risks, I always question that, not to talk myself out of it, but to say, right, just keep it in check, right? Do not get arrogant. Do not get carried away. Do not get over your skis. All the other things I could possibly think of. You get the idea, right? But I don't want to be the king of cliches today. I'm just saying that's where I always end up with. Now, that's usually bullish, but it can be bearish too, right? So that's what I mean. You should really, I think, when you get to that point where you think it's easy, just be careful. It's not really that easy that all the time. I know, again, I covered this one already. All I would note is that I note these things for a reason, because that's going to tell you, right, that the market's temperament has changed. So if you see the temperament changing, the market can't hold levels. That can be a big deal. So on that note, I think I'm going to try to shift us. Well, I'll cover the next few. Conditions have not been improving. That's something I think we've seen where we've been making the case, yeah, they got a little better, but it's been obvious, right, that there's been this divergence between the major index levels, mostly buoyed by absurd large cap jam jobs, narrowness of the rally. That's held it up, which is often the case if things do work that way. And then you have this persistent problem under the surface that can sometimes resolve bullishly in the end. It can sometimes resolve bearishly. But you have to be, I think, you have to have your risk management antennae attuned to that when that's happening, because those are the times that normally precedes these significant pullbacks. You normally see problems developing, and it just takes a while for there to be a recognition of that. But the market, I think, starts to discount that in some ways under the surface of the indices, and then that shows up later on in the indices when a lot of the final bigger names or what stocks of the moment tend to give way. So again, this is not always disastrous, but when you see those things persisting, right, you have to get ready for a possible spillover, and that usually comes from some subsurface problems that emerge, right, and become more obvious. And I think that's sort of happened with AI being questioned. The whole AI story has come under, let's say, scrutiny, and certainly the financing for it has, and CDS, the credit default swap, basically the insurance on the debt on some of this stuff has begun to become very pricey. The insurance, excuse me, has gotten very pricey, and that's often a sign that people are very concerned about risk, and then of course there's spillover from there. So on that note, let us reposition. Let's see if I can get us out of this, and if I can get us out of this. For some reason, it's not doing it though. There it goes. Okay, so we will then go to a different screen. Let's go to share. I will share my main screen, screen 3. Nope, there, got this as screen 5 now. I'm glad I checked. Okay, so screen 5 should switch over, and then I'll move this, and then we'll continue to cover things. But I may as well just knock this out while I'm here. But this was part of the discussion briefly. This was all cobbled together very quickly by me, doing the best I can, but even with less time this time around. Anyway, we've got this chart of BTC. We may as well cover it while we're here. And we've been looking at these support levels here, right around the 100,000, right near it. There's that sort of rally attempt we talked about. You had your declining SMAs. The blue or cyan colored 20-day was declining right there. Pretty much stopped it in its tracks, reversed it right back on down below the 200 purple. That's the last of them. Now you have your short-term SMAs downsloping beneath, right, some other key SMAs like the 150 and the 200. So looking pretty bleak. I don't know, probably getting close to where you would say approaching oversold at this point. So you maybe see some sort of rally attempt or what have you. But the bottom line is we use this as a risk off barometer, excuse me. And this is clearly risk on, risk off. This is certainly telling you right now that some of the speculative stuff is risk off. Now, I have never been and probably never will be an expert in anything related to crypto. So I just want to say that up front. But from what I understand, news-wise this week, this has really taken the toll on MicroStrategy. People are making the argument that apparently if all they're going to do is buy Bitcoin or what have you, essentially, I know they do other things, but if that's all they're really going to do, why do I need them to do it for me? That's what emerged. And you could see when sentiment shifts, right? And people no longer have the same bullish outlook, and the tide turns and the money turns, right? It can really get whacked bad. So this is why you have to manage risk right here. Even if you believe in this in the long term, to go from 457 to 194 is definitely a serious shillelagh that happened here. It happened just overall. We had IBIT as one of our momentum names this week. Got that out on Monday, and was a fortunate week for people that played in there because they gapped it up kind of with the crypto running, looking like it might try to run, and then that failed, reversed, and down from there. So the rest of the week was easier than the start of the week, but we didn't get the idea out until Tuesday. Well, Monday night, Tuesday morning was the first time you could really trade that with options, I believe. But just the whole idea that just that space had it rough. You could see some of the other names that are in there. Just a very overall, right, a rough week for crypto. So that's part of that. Now, the other interesting aspects are the dollar, right? So we usually look at this, I'm doing these things a little out of order, but usually you'll see that there'll be this sort of flight to safety and that you'll get a little bit of a bid in things. But really, what happened was it seemed like they went out of crypto, and at least at the start of the week, kind of went into the precious metals. And the dollar really lost its steam. There was more of a flight towards precious metals than into the dollar, or you didn't really see the bond yields really dropping so much, right? Where you've seen that before, which people always call that, flight to safety. And you didn't really see that. By the end of the week, you could see that the 10-year, just one of the ones we use week in, week out, that really ended the week kind of on the high side, right? So very interesting developments there. The VIX, this is why these are just super interesting times. The VIX, once again, tried to get going and picks the back half of the week to do so. And then they monkey hammer it right back down again because it's another Friday save, right? Another Friday save in the market. But again, I would argue that this particular save at least had the I think the folks that were closing out their shorts, right? When you open down this far and you've dropped this far in 3 days, you're getting short-term oversold. And so when you find support, and this line here, I think, is from last week. I think I added it and we even talked about it, or at least I talked about it earlier this week, maybe on Monday with our UOA Pro webinar. But this is a line I think a lot of people would hate. And you can see that I don't really care about that. I put the line in there and the line seemed to matter. It sounds silly, but I've seen this happen many times before in my experience. So again, the line came in, You have what could be a double bottom, big strong reversal here. You're still back below what we drew last week in terms of resistance. We said if you could get above there and hold, right, that would be something, but you had to watch out for lower high, double top, slightly higher high. You still have to watch out for all these things, right, each and every time when you're up against Wall Street prestidigitators, and that's what we're up against. So overall, remember, under the surface, while this channel has been tracing itself out nicely, we've been uptrending. You have to recall a couple things that are also part of our weekly program, that these sectors have become messy. In other words, right, very few sectors are really joining this party. You have defensive sector, healthcare, right, XLV, that had the very strong bid this week. That got a little absurd in the short term itself. Energy, kind of a different story, kind of hated, I think, to a degree, and just continues to try to want to work, I think, higher more so than lower, right? So energy, not a bad week at all, and back up not far from the recent high. If you look at the rest of this group, though, there's not a lot to like. They put a late save together over here, and we could call former leader XLK. Of course, that goes along with SMH being saved, the Qs being saved. But XLC, I think, despite really good news with maybe Google late in the week in terms of Warren Buffett's company, Berkshire Hathaway, which is Google being part of this XLC, I believe. I think that that could maybe help this, but you can see these are the former leaders. They're looking rough. What we wanted to see, XLF, XTN, we wanted to see those join the fray on the bullish side. They've continued to attempt to do so, but they fail each and every time, right? So not a good look. Another troublesome problem, really, XLY clinging to life. So the discretionary starts plumbing new recent lows on its way back down to even more retracement after failing to break out. Not a good look. Staples still not looking good. In other words, even staples don't look good. Transports, we talked about failing. You had this big surge in materials, and they started giving it back towards the end of the week. Now, that could have been some rotation out of them, some profit taking in them because of the kind of surge they had earlier in the week. So you don't want to read, I think, too much into that. But overall, still downtrend characteristics can be seen there. XLI, which was really defying gravity relative to other things, that also basically rescued from the abyss on Friday. And XLU, which is maybe not the defensive player that we used to view it as, and jury may still be out on that to some extent. It might be mixed, but the bottom line is not a great week there either. So you look at your sectors, and I don't know what you can really walk away thrilled about here. Overall, I think this worsened again, or relative to where it was last week. So we said, I think, not too bad last week. I'm going to say not terrible, but not awful, but not anything special in a good way. Now, the fact that things really didn't deteriorate even further, I think, is the silver lining. You're still clinging, much like the SPY and other things are clinging to critical support, right? This critical support that we hit, they managed to cling to that. They managed to hold above the golden 50 SMA that I'm sure you all can see on this chart right there. So that's the good clinging that's going on so far. And don't, I would say don't sell it short just yet in terms of, does that mean anything? I think it's a for example, you think it's a bogus Friday save. But remember, these bogus Friday saves have become commonplace, and they've been able to sustain this rally. So you don't really want to, I think, trash this thing too easily, especially at just the wrong time, because, right, think about them just clearing out more people this week, getting people spooked by what was happening again, just like they did really last week. And now they have two weeks really in a row where they cleared people out by the end of the week, probably, and flushed them, and even took shorts that were successful out, right? So those people may, if they get another pop, may get started on something in terms of shorting again, and then, right, that sets the stage for shorts re-entering People thinking this thing's about to break down right in time for the seasonality, bringing sand to the launch pad. This is the bullish outlook or scenario that I would spin, right? I'm not taking that side. I'm just saying that that's possible. The diamonds you have to look at as a disappointment. You have this rip off the 50. They're all of a sudden, it's the 1950s all over again. Baseball, apple pie, Chevrolet, and the Dow Jones Industrial Average. And instead, right, you retreat back from whence you came. You're barely up on the week compared to where you were after last Friday's save. So that's not really the way. I've said this so many times, but this is not really the way you want to make new all-time highs and then fail to hold them for any real length of time. Unfortunately, in other words, there's better ways to do it, but it doesn't mean it's over yet. The trends, as you can see, just from the slope of all these moving averages here, except for the most short-term ones, but effectively all the longer-term SMAs are still upsloping. So I'm not the guy that depends on that, but that's a very easy visual to just point out to say, look, these trends are up still, right? So a lot of people, I think, are going to look at it that way. So again, this is the caveat. You really can't, you might not like what you saw this week, and you might feel like it was really heavy. And I think beneath the surface it was. But if we're talking about the indices, the major indices, it's a different story. There was even a save here right in the Qs, right? There was even a save here in the Qs. Now, we did have some good SPY paper came in at the top or near the top this week. So we got another put trade on from a higher level. Some people probably could have already traded that and made a little bit on that probably not a big score, but there was a good pullback from the day that we topped out, which I think was Wednesday. And we also noted we had that Q paper from way back as well. I don't think there was any more Q paper, but you could see that, right, that's a washout there, a clear out, a clean out, whatever you want to call it. People have different names, but new low, reverse strongly right back into above support line, right into the channel, right? So again, the other point we could raise here is this is why I don't really argue, but this is why I really don't agree with the people that argue that it's easier to make money on the downside. I feel like you can make money on the downside, but you really have to nail it. And I play it myself, so I don't disagree with anyone saying you can make money. It's just that I think you get put through the ringer. They really could put you through the ringer on the way down. It's not easy to be that patient all the times. And so because there's so many rips back before the rallies are very sharp and bright, and they can really frustrate the living daylights out of you. So again, when you see that big gap down, you're probably better off covering and then reestablishing, right, when you think it's the right time, even if that's 3 minutes later, just because this is what they're capable of, and we all know that. And I'll make another point about that when I get back to the slide. IWM, another part of the disappointment, right? Because the hope was, right, that things would eventually start getting better on Main Street. Probably a silly notion, the way this world has trended for such a long time, literally decades and counting. I get that. But we're still hoping nonetheless, because I really hate to see what's happened to our country in terms of so many people being left out of the wondrous times that the media periodically tells us about, especially when the media is Wall Street centric. But this was a disaster piece that was saved here at the very end. I mean, this thing was on its way. You don't see a lot of support beneath there, right? You could be dropping down another 4 to 5% without a big bounce because of the nature of how we went up in this area. Sure, you could say there's some other fibs there. We could make that case. I'm not worried about that this week. I'm saying, right, this is really an ugly look. Now, you could say the one good thing is you got pretty oversold. You weren't in a horrible oversold condition, but you did get pretty oversold. You did have that, and you're back above the 100. I would say relatively comfortably, because you're not right near it, right? But this is another possible washout where you close back above this low. This was a low maybe people were trading against. They all get flushed. now you've got that, right? Now you've got that happening. So think about next week. Think about the fact that we had Apple paper. Think about the fact that Apple is such an enormous name. Think about the fact that Apple is very close to the all-time high, AAPL. And think about this in terms of staying power, right? Where we had some call buying. I just put an idea in not too far before the close of trading today because there was some near-term paper, and you could see we had a lot. We could see the line we had coming from way over, and we drew through here to make that happen. And calling this more or less what people tend to call a throw over. You could call it an overshoot. Anyway, point being that this here, you're not far away from this all-time high, right? You're just, for Apple, not too far. There was some paper there. So this definitely is the kind of paper that could be a hedge because it was slightly out of the money call buying. That's at the time. That's exactly what I would use if I wanted a real hedge. I wouldn't buy way out of the money. If I wanted a good hedge, just in case, I would do that. But with NVIDIA EPS looming, we've made the case before, a lot of times the gang is reluctant to let things really flush if they're going to until the EPS of NVIDIA is out of the way. This is obviously something that could cause or help aid a squeeze as we approach it, which basically we are approaching it, right? You open up and you're a few days away. You open on Monday, you're a few days away. You get this strong support right near the 178-ish level. You got the 100, excuse me, in white right near there. Really good recovery. You can see it's kind of flat line. It's kind of like a flat line haven. There's a lot of touches around there going back in recent times, which way more than longer dated ones. And I don't know if there's much in the way of longer dated ones anyway, but you could definitely see kind of like, I think, sort of like a double bottom, like a kind of like a narrow double bottom that could form there. Given the kind of volatility we've seen lately, this move, that move, right, the pop back up, the drop from there, you can't rule out anything. You can't rule out a new all-time high. So I got this out there, but think this is your big dog. You lift this, you lift Apple. That could really mask over things like they've been doing in so many ways. Not predicting that, just saying it's there. Seen a bunch of call buying in NVIDIA. So don't want to mislead anyone. Not that they're always right. Not that there aren't speculators that don't know a damn thing. Not that there aren't hedgers. I'm just saying we've seen a good deal of call buying, and I'll get to that. But what I wanted to note while this pops up, excuse me, let's just note since we're here, we're in extreme fear. We were in extreme fear a week ago. Here's the timeline, right? So you're kind of dawdling around near and in extreme fear. So that's a contrarian take, obviously, where you're looking to say, like, that's overdone. It's been there for too long. Excuse me. Excuse me for a moment. I need to get a little drink here. And then you've got the AAII sentiment survey. Again, you may not like either one of these. At least it gives us something to refer to. You could see how the bearishness has really spiked here, right? So before you start wanting to just sell everything and buy VIX call spreads and puts in the queues and whatnot, just keep in mind, right, that in the last 6 months, this is the second highest reading and not by very much, right? So it's not behind the highest reading that we saw. September 10th was the highest reading that we saw. Let's go back on the charts in the SPY to September 10th. And let's see what happens. And I don't even know the answer to this, but I'm going to guess that was not too far from a low. Let's just ballpark it. September 10th is right there, right? So that just happens to be when the survey came out, and you could see, right, you got fairly extreme. You could see what the next month delivered. So don't want to. Let's take a look at 10-10 while we're at it. Let's see anything near 10-10 and 11-7. And so 10-10, closest one's going to be the one that followed that one probably would be right there, the 15th. So you were at 46 shortly thereafter. And here, nothing really to write home about on the November one. So, but yeah, so you can see there's a little bit there. So when people get a little too tilted, especially against the trend, there tends to be this surprising rally. Anyway, you get this comment where Neil Sethi is noting what I believe Mr. Hartnett from Bank of America had to say. So here you go. This is basically summing it up. Cash is insufficient to finance AI CapEx arm race, wider credit spreads. So this is what people are starting to become concerned about, that in the banking system, there's not enough reserves. And in this world, that there's not enough cash flow. There will not be enough cash flow given how much money some of these players are spending to make this all happen. So again, I would love to look into things like this if I had time. I can only pass it along as that this could be causing trouble. This is some of the subsurface stuff that we've been referring to. It's been out there. I think we noted this in a lot of webinars really for a long time. I think Ryan's been doing a great job noting these kind of things. And I've tried to note that these things appear, but they usually get ignored for a while until they're no longer ignored. Here's how there's been, in terms of the cost of insurance credit default swaps on some of this debt. And you can see how Oracle and CoreWeave have really popped dramatically. So if you want insurance on those, you're paying a premium relative to where you were in the past few weeks, even the past day, the past week, the past month, right? They're all up. So just take that for what it's worth. And that's all I really wanted to share. We could do tabs forever. Another thing I wanted to show, and I'm just going to tilt this down a little bit for everyone just to see the entire week. But here's your entire week right there. We started out on the 10th. I'll leave that at the very bottom. That hit. I just want you to see this because when I tell you that there's been a rash of aggressive call buying, this almost appears as though people are sensing that there could have been maybe some shortage that or something crazy that developed, but you can see what's been happening in some of this near-term paper. Really, they really kind of went bonkers over SLV. We put some trades in earlier in the week. We were fortunate because, as you can see from earlier in the week in the 45, some of these hits took place up here at 48.66. So not a bad little pop for a few days, which was good. We used a near-term contract in that one. I think it expires next week. There was some deck paper that hit here as well, but most of it was near term. GLD, SLV did have really nice pops, but retreated. That's part of our notes, but I don't think the GLD was nearly as active or as strong as the SLV. Although, right, not a bad week. A little bit better of a showing than I thought, to be honest. My memory didn't catch this many, so you could see how active they were. So I retract that comment. I was more active than I had recalled. So there you go. Both of them, and we had ideas in those. We also had ideas in Oracle recently, and so this credit default swap stuff has been causing Oracle to have issues. We also had CoreWeave this week too in UOA Essential as a potentially bearish idea. And when these things start happening, it really can affect the panic. Really can spread and set in, and the stock prices can really reflect that. And you can see that Oracle has been getting smoked until today. CoreWeave, the same, getting smoked. They arrested that today, but it was really one of those things where I saw that paper pop up. I knew there were problems, that they were having problems, and there was talk, right, subsurface talk about these things. It was hard to like the charts as well, in my opinion. And I think after Oracle put together that absurd jam job here, and it's been trailing off, I was looking at it originally saying, this thing could maybe really flush this whole thing out. We had paper, the rest is history. But I'm just saying, it's nice, right? I really like things like this where you can put together a strong composite picture with the charts do not look good. There's serious put buying happening in these names. There's problems with their debt potentially. People are paying premiums to protect themselves against risk or to benefit from debt defaults in these names. That's kind of a big deal. So just wanted to note that. So let's pull this back over. Let's see where we are. I went through a lot of things, but I want to make sure that we're covering everything. I did cover this here. So yeah, I mentioned the bank reserves. I mentioned the credit default swap situation, which is really turning into kind of like a source of fire in the markets a little bit at this point. We talked about, again, maybe this is part of the reason why there is more risk than meets the index eye. Now, the indexes did finally succumb again right after that short squeeze to start the week, but this is after the heels. This is more of a reminder, right, that we've had these big Hindenburgs, which I'm not really testifying for them. I'm just saying that people do note the Hindenburg occurrences. You can look into it. There's other things too, but it just generally hasn't been good in terms of breadth and sector participation. Things became super concentrated, etc. You had your credit default swaps. You still have geopolitical and other types of risk, domestic political risk as well. And you could, that stuff might not rear its head. Then again, it may. A lot of people just brush that aside, but that stuff can really strike. So again, more of an argument for if you've had great runs and you're nearing the end of the year, you may want to be smart about ratcheting up your calls. You don't have to stick with 99 delta calls you bought earlier this year or over the summer or whatever the case may be. You can take yourself right to the at the monies. You can go slightly in. You can go to the 70 delta ones and still take a lot of money off the table, depending on how far out in time you're willing to go. So just a reminder there. So kind of getting to the where are we? I would say the uptrend's clearly under pressure. The market became short-term oversold. It may not matter, though, if the system is unraveling. In other words, the oversoldness. My news neutral assumption would be to expect a bounce attempt earlier in the week again. And if successful, let's not sell it short, Judge. It could ultimately clear the runway for the Santa end of year move if the systemic issues disappear, the geopolitical disappears, the domestic political disappears. Trump prefers to have a nice holiday season, let's put it that way, and we don't we don't get any Trump being Trump news, but I don't think you can count on that. I think Trump is destined to be Trump. For better or for worse, I guess it depends on your viewpoints, but I'm just saying I think Trump is a newsmaker that enjoys making news. Anyway, the risks are emerging more in a sense that more people are paying attention to them. Does that mean that they're on their way to becoming a non-story? Maybe that happens too. But the stories are being questioned. The wheels nearly came off again, but as I covered, we hit that support for the first time. It was our first hit of it this time down, and usually, right, without something really, really unraveling that's being reported, they're going to try to support that, especially on a Friday. That's why I'm putting near instant save. So you're going to get that reflexive end of the week squeeze that we've seen time and time again. And for everyone that thinks it was BS, and you may be right, all I would point out is that it's worked time and time again to save the market, and the uptrend has remained intact. So we might want to scoff at the BS that goes on, but the BS has been effective. And actually, it's been effective for a very long time. If you want to talk about how they've changed everything since QE began all those years ago, I feel like you've been in a hyper managed situation personally. My market observations are that the market's behavior has changed dramatically ever since that began versus how it used to be and seem more organic. People are going to argue there's other reasons for that. There very well probably are, but they don't explain it all, in my opinion. That's a whole nother subject, though. Bottom line game plan. So I would again remain at a high DEFCON alert status. just like we've said for the past 2 weeks. I would not lose sight of fake outs. In other words, even if you think we're getting a breakdown below below certain levels, and you're thinking to yourself, this is it, this whole thing's unraveling. Now, if the news is driving it and you're hearing that the wheels are coming off from within the system, and things are getting annihilated, yeah, there's probably panic and all that. Okay, then maybe you're probably not going to get the near instant fake out. But remember, despite what people say, there's been many interventions in the US stock market. There's a lot of people I like and respect, and I think they're speaking in earnest, but I don't agree with them. I think there's been many saves over the years since really since Mr. Magoo, Easy Al Greenspan assumed the helm. But anyway, that's a whole other story. That's why I think why the President's Working Group was created there in the late 80s. But yeah, so don't sleep on, hey, it's breaking down, the whole channel's lost. You get one dip below the channel and they then rip it back up, right? Because these guys are the masters of the shell game. So just don't lose sight of that. Stick with your discipline. That's why IMR is there if necessary, meaning initiate your bearish trades, manage your bearish trades, and even reverse your bearish trades if need be, right? That's honestly, if you want to make money trading, you have to go with the flow in the short term. And if that's what it requires, which is even a 180, you got to do your best to do that. I know it's not easy, never really easy to do, because you think one thing pretty strongly with confidence, and then suddenly you're like, nope, I'm going to go the other way. But it probably works better than fighting against it. I can say that. Remember the seasonality, the trends are still up too, right? So we're still above support too. So we closed the week with this concerning complexion. I think the Bears are still trying to beat the clock, which is completely really ran out on them at this point. But again, it does seasonality, the Santa seasonality even is not really a birthright, despite the way that people think it should be. It sounds like with some of these interviews they put on financial television. Anyway, that seasonality is looming. So again, I would be ready if you're not already in stuff. If you're in stuff, be ready for whatever, right? You got to manage. You might have to close. You might have to reverse. But you've got to be ready. Have it all ready to go. If you haven't, it could still unfold. The news will probably be what dictates that. So you'll know if there's kind of like reports of, uh-oh, this is the default, this bank is breaking down, there's banking issues, that happens, and then you get the counterparty risk and the domino effect and so on. So you'll probably be hearing about that, I would think. But again, they've done things surreptitiously as well, so it's tough. Anyway, repeated thought again this week would be, if everything's going to be wonderful the way that we're told it will be, then do we really need to be exposed at all times? Meaning, right, if you saw what we've seen in and covered in these videos in our modest way that we do, a quick, dirty, modest way that we do, do you have to really be going for the gusto on the long side exclusively all the time? And I would just point that out, that there's nothing wrong with hedging. There's nothing wrong with dialing it back in when you really see storm clouds. You can unhedge or full throttle pretty quickly these days. They even have quadruple, triple exposure ETFs that you can do this, that, and the other thing, and some of them with options. So if you want leverage upon leverage, you can get it. So all I would say is a big part, really, over the long haul, if you're long haul oriented, a big part of really outperforming is to not give so much back after there's been a tremendous run. When there's been a tremendous run, it does tend to lull people into a false sense of security, and you just don't want to do that because there's give back, and some stocks can have major give back. And I'll try to cover them here, but I think Soros made this point in his book. His book, I don't think, was very well received at the time. I'm not sure how people view it now, but he did make a point of, if you can avoid these strong drawdowns after great runs, it really is a massive difference maker. So maybe just something to think about. I'm not saying it's easy, by the way. I'm just saying something to think about. Um, I would say that with Trump being Trump, we talked about that. Same old story. I'm back in small with VIX call spreads, nothing really big, very small. I still have some long positions, but there's very few of them as well. I basically decided I haven't seen enough to really feel confident either way. And if you notice where we are in the charts, I think that's right in line with those. So I'm just going to continue to be nimble, let matters sort themselves out further. And then if the system comes under duress or other things develop, asterisks, then of course I'll engage, right? I'll put verticals, butterflies, just naked long puts, as people call them. The whole works. I'll do whatever, and I'll probably get into more VIX call spreads as well. But as of right now, I'm hoping that scenario doesn't unfold, and we avoid that because it's a lot more fun if we get that good trading wise and money profit wise. I think to get a nice hold and then a resumption of the seasonality and then good strong end of year trade that maybe carries us into next year. But we'll see. You can't always get what you want. Same old reminder: beware of those charcoal and black swans. Charcoal ones are ones like we've been talking about with this CDS, where these types of things and all the other economic problems that are out there that have been sort of marginalized, I think greatly marginalized, those are things you can know. We covered some of them in tabs last week. We don't do a great job of that consistently because this would be a forever video and it's already probably too long. But you get the idea. There are certainly black swans, but there's even political things that are out there that I've heard about that could happen soon. And I'm a nobody, but I'm just saying I've heard about these things, and the arguments I've heard wouldn't shock me if they become true. I just don't know if they will, right? Some of these things do sound somewhat plausible to me. So again, those are what the media will refer to as black swans. But my argument's always been, if you were the real media, a lot of these things wouldn't be black swans to most people. And the reason for that is that you'd be doing your job, but you don't. You just gloss over everything. You don't have to say that, hey, listen, this is percolating, but all you have to say is like there is some chatter out there. Here's what we found or whatever. Blah 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 blah. They don't really do that. It's kind of unfortunate. It's all kind of hype and misdirection. But that's that. One thing I did want to note, we wrapped up on that. So I'll try to show, right, when the tide turns, let's look at what happens when the tide turns. So I got a couple of these quantum names in there, started to see a little bit of sentiment shift on those. We got the quantum names in. You could see this was initiated about 8 days ago. And this is what happens when you're in speculative stuff that's ran, right? So there's the Ion Q one. We also had Rigetti in this space as well. I say as well. Oh, it's not doing that for me. Let's get it a different way. RGTI. Oh, I know why. It's my own fault. I'm the one that keeps screwing this up. GTI. And I'll just click on the original idea. That also went out on the 6th as well, just so you could see we had this in there. This had the EPS kind of in the way. But this is what happens, right? This is why you've got to be really careful in some of these speculative names that have had these amazing moves, because there is another side to the mountain, right? And so after this failure here, right, we started drifting back off the UOA hit, and you could see the rest of the story from there. Really dropped down, I think, to our lowest target level, which was pretty far away for a 30-something stock at the time. And then Ion Q, really a little bit better probably in terms of how the chart looks visually, but still a very ugly week and development here, right? So you just got to be careful when these things do this. Remember, I've talked about it many times where a lot of times you could see this consolidation, and then you start really breaking out. This day is your first indication, then you go. So a lot of times these things will return to the scene of the crime, so to speak, or in other words, the breakout level from which they came. I've tried to share these little things that I've seen over the years from time and time again. That's another one I just wanted to share. So I'm just going to go back. I'm really not talking about levels this week. I'm talking about big picture. I think it's very clear that this is really your breakdown level. Where you go from here, you want to see this thing obviously get through this high now. And that's it. I'll leave it to you because we're running long on that. But you want to see, right? You really want to see these levels that were set recently, this low hold here, otherwise trouble. You want to see this thing really get back above here before you feel like, okay, we're powering into new all-time highs and they're going to really pour it on here potentially by the end of the year to give themselves the best bonus they can possibly dream of under these current circumstances. Today's low in the Qs needs to hold, and then this week's high is so close to here, but pretty much this week's high, right, for where you start saying, okay, we're back in business, and now we're going to try to make our way to the all-time high and maybe beyond. IWM, a totally different story. This week, the low's the mess. You need to get back above this 20-day. You just got to get it back above there. And that's a tall order. You're probably looking at 3 to 4% move just to get back up there. So, but that's really what you need to start doing. Otherwise, you're just below a range that's got you tamped down and SMAs that are going to keep you tamped down. And that just keeps really more of a negative technical cycle in place than a positive one, despite the rising long-term SMAs. But let's see what news develops. I think on that note, I'm going to wrap things up. I do hope that something I covered or shared this week helps you out in some way in this upcoming week or some week in the future. Try to do my best to remember everything. Just very, very pressed for time and very hard to even find time to assemble the tabs check and things like that I prefer to do. But I think at least we covered our week in, week out nuts and bolts. And again, I hope this helps you. Thanks for tuning in. Hopefully you'll get this early this weekend. I want to wish everyone a wonderful, safe weekend as always, and come in with a nice frame of mind to get the week started next week. Everyone take care until then.